I'm about to tell you something that the entire financial industry does not want you to hear. The very products that Wall Street has been selling you as safe, diversified, low-cost investments are actually ticking time bombs sitting in your portfolio. And when they explode, and they will explode, millions of investors are going to lose a significant portion of their retirement savings. I am talking about ETFs, exchange-traded funds, the darling of the passive investing movement, the products that every financial advisor recommends. The investments that have absorbed trillions of dollars over the past 2 decades. These products have a fatal flaw that almost nobody is talking about. And 5 specific categories of ETFs are particularly dangerous right now. Let me be very clear about something up front. I am not against all ETFs. Some ETFs are perfectly fine investment vehicles. A simple, broad market index fund with high liquidity and low costs can be an excellent way to build wealth over time. I have said this many times. Most investors would be better off just buying an index fund and holding it forever, rather than trying to pick individual stocks. But the ETF industry has evolved far beyond simple index funds. It has created exotic products that most investors do not understand. Products with hidden risks, products with structural flaws, products that will behave very differently in a crisis than investors expect. And right now, with markets at elevated valuations and economic storm clouds gathering, these dangerous ETFs are more vulnerable than ever. I have spent my career identifying asymmetric risks. Situations where the market has mispriced something, where investors are not being compensated for the risks they are taking. That is how I made my money shorting the housing market in 2007 and 2008. I saw risks that others were ignoring. I positioned accordingly. And when reality caught up with prices, I profited enormously. Today, I see similar risks in certain corners of the ETF market. Products that have grown massive during the bull market years, that have never been stress tested in a real crisis, that contain structural flaws that will only become apparent when everyone tries to exit at the same time. These are the ETFs I am warning you about. Let me start with the first category of dangerous ETFs, and this one might surprise you. I am talking about bond ETFs, specifically long-duration bond ETFs and high-yield bond ETFs. These products have attracted hundreds of billions of dollars from investors seeking income and safety, but they are neither safe nor are they going to provide the returns investors expect. Let me explain the fundamental problem with bond ETFs. A bond is a contract. When you buy an individual bond, you know exactly what you are getting. You know the interest rate. You know the maturity date. You know that if you hold the bond to maturity and the issuer does not default, you will get your principal back. There is certainty in owning individual bonds. A bond ETF is completely different. It does not mature. It never returns your principal. It holds a constantly changing portfolio of bonds, selling some and buying others to maintain its target duration or yield profile. And here is the critical part. The price of a bond ETF is determined by supply and demand in the market, not by the underlying value of the bonds it holds. This creates a potential disaster scenario. Imagine a situation where investors panic and want to sell their bond ETFs. The ETF sponsor has to sell the underlying bonds to meet those redemptions. But what if there are no buyers for those bonds at reasonable prices? What if the bond market is frozen, as it was briefly in March of 2020? The ETF price can diverge dramatically from the value of the underlying bonds. We saw this happen during the COVID crash. Some bond ETFs traded at discounts of 10, 15, even 20% to their net asset value. Investors who thought they owned a safe, liquid investment discovered that they could only sell at a massive loss. The Federal Reserve had to intervene and essentially backstop the bond market to prevent a complete meltdown. Now think about what happens if we have a real crisis. Not a brief panic like March 2020 that was immediately addressed by unlimited Fed intervention. A sustained crisis where the Fed cannot or will not intervene. The structural flaws in bond ETFs will be exposed in catastrophic fashion. Long-duration bond ETFs are particularly dangerous right now because interest rates have risen dramatically. These ETFs have already lost 20, 30, 40% of their value over the past few years as rates have moved from near zero to over 4%, but many investors are still holding them, hoping for a recovery. They do not understand that if rates stay elevated or rise further, these ETFs will continue to decline. Let me give you the math. A bond ETF with a duration of 15 years will lose approximately 15% for every 1% increase in interest rates. If rates rise from 4% to 6%, that ETF loses another 30%. These are not speculative products. These are products that millions of retirees own because they were told bonds are safe. Bonds can be safe. Individual bonds held to maturity can be safe. But bond ETFs are not bonds. They are derivative products that behave very differently, especially in times of stress. If you own long-duration bond ETFs, you need to understand this risk. High-yield bond ETFs are even more dangerous. These products hold portfolios of junk bonds, bonds issued by companies with weak credit ratings and high default risk. Investors buy them because they offer higher yields than investment-grade bonds, but they do not understand what they are actually buying. In a recession, default rates on high-yield bonds spike dramatically. Companies that were barely making their interest payments suddenly cannot make them at all. They default. The bonds become worthless or nearly worthless. A high-yield bond ETF that was yielding 8% can easily lose 40 or 50% of its value when defaults surge. And here's the structural problem specific to high-yield bond ETFs. The underlying market for junk bonds is not very liquid. These bonds do not trade frequently. When they do trade, the bid-ask spreads are wide. In a crisis, when everyone wants to sell, there may be no bids at all for certain bonds. The ETF, however, trades continuously on an exchange. Investors can sell their ETF shares anytime the market is open. But if the ETF cannot sell the underlying bonds, or can only sell them at fire sale prices, the ETF price will collapse. The liquidity that investors think they have is an illusion. It only exists in calm markets. In a crisis, it evaporates. I would get out of long-duration bond ETFs and high-yield bond ETFs immediately. These products have structural flaws that will be exposed in the next crisis. The risks are not worth the returns. The second category of dangerous ETFs is leveraged and inverse ETFs. These are products that use derivatives to amplify returns. A 2 times leveraged S&P 500 ETF aims to return twice the daily performance of the index. A 3 times leveraged NASDAQ ETF aims to return 3 times the daily performance. An inverse ETF aims to return the opposite of the index performance. These products are designed for short-term trading. They are absolutely not suitable for long-term investment. But millions of retail investors own them anyway because they do not understand how they work. Let me explain the problem with leveraged ETFs. They reset daily. They are designed to deliver their target multiple of the daily return, not the monthly return, not the annual return. This creates something called volatility decay or beta slippage that destroys value over time. Here is a simple example. Imagine the S&P 500 is at 100. Day 1, it goes up 10% to 110. Day 2, it goes down 9.1% back to 100. The index is flat over those 2 days. Now, imagine you own a 2 times leveraged S&P 500 ETF that also started at 100. Day 1, the index is up 10%, so your ETF is up 20% to 120. Day 2, the index is down 9.1%, so your ETF is down 18.2%. 20% of 120 is 21.84, so your ETF goes from 120 to 98.16. Do you see what happened? The index is flat, but your leveraged ETF is down almost 2%. This happens because of the mathematics of compounding. When you lose money, you need a larger percentage gain to get back to even. The daily reset of leveraged ETFs creates a structural drag on returns. Over long periods, in volatile markets, leveraged ETFs will lose most or all of their value, even if the underlying index goes nowhere or even up. I have seen investors hold 3 times leveraged ETFs for years, watching them decay to nearly zero while the underlying index was positive over the same period. They did not understand the product they owned. Inverse ETFs have similar problems. An inverse S&P 500 ETF is supposed to go up when the market goes down. But because of the daily reset and volatility decay, it does not work that way over longer periods. In a volatile market that trends sideways or even down, an inverse ETF can still lose money. These products also have significant counterparty risk. They use derivatives like swaps and futures to achieve their leverage. If the counterparties to those derivatives fail, if there is a systemic crisis that causes derivative markets to seize up, these ETFs could become worthless overnight. I would get out of all leveraged and inverse ETFs immediately. These are not investment products. They are trading tools designed for professionals who understand exactly how they work and who close their positions at the end of each day. If you are holding them as investments, you are making a serious mistake. The third category of dangerous ETFs is thematic ETFs. These are products that focus on specific themes or trends like clean energy, artificial intelligence, cannabis, cybersecurity, space exploration, electric vehicles, and dozens of other narrow focuses. They have exploded in popularity over the past few years as investors chase the latest hot trends. Thematic ETFs are dangerous for several reasons. First, they typically buy stocks after they have already run up in price. By the time a theme becomes popular enough to launch an ETF, the stocks associated with that theme have usually already made their biggest gains. You are buying high, not buying low. Second, thematic ETFs have high turnover and high fees. They are constantly adjusting their holdings as companies fall in and out of favor with the theme. This creates transaction costs and tax inefficiency that eat into returns. Third, and most importantly, thematic ETFs are concentrated bets on specific sectors or trends. They are the opposite of diversification. When the theme falls out of favor, these ETFs collapse. Let me give you some examples. In 2020 and early 2021, clean energy ETFs were the hottest products in the market. The thesis was that the transition to renewable energy was accelerating, that government policy would support clean energy, that these companies would grow dramatically. Money poured into these ETFs, driving prices to absurd valuations. Then reality set in. Many clean energy companies were unprofitable. They depended on government subsidies. Rising interest rates made their capital-intensive business models less attractive. The clean energy ETFs collapsed, falling 50, 60, 70% from their peaks. Investors who bought at the top lost enormous amounts of money. The same pattern has played out with cannabis ETFs, with speculative technology ETFs, with SPAC ETFs, with any number of thematic products. The theme gets hot, money flows in. Prices rise to unsustainable levels. Then the theme cools off, money flows out, prices collapse. Right now, the hottest theme is artificial intelligence. AI-focused ETFs have attracted billions of dollars. The stocks in these ETFs have soared. The valuations are extreme, and I believe the same pattern will repeat. When AI disappoints, when the hype cycle turns, when investors realize that most AI companies will never achieve profitability, these ETFs will collapse just like clean energy ETFs did. I would get out of all thematic ETFs. These products are designed to separate you from your money by capitalizing on whatever trend is popular at the moment. They buy high and sell low. They charge high fees. They concentrate your portfolio in exactly the wrong areas at exactly the wrong times. The fourth category of dangerous ETFs is emerging market and single country ETFs. These products give investors exposure to foreign markets, particularly developing economies like China, Brazil, India, and dozens of smaller countries. They have been popular with investors seeking diversification and growth. The problem with these ETFs is that they expose you to risks that most investors do not understand or appreciate. Currency risk, political risk, regulatory risk, liquidity risk, and in some cases, the risk of outright expropriation. Let me focus on China specifically, because China ETFs have been enormously popular and enormously dangerous. For years, investors poured money into China, believing that it was the growth story of the century. Chinese companies were growing rapidly. The Chinese middle class was expanding. The thesis seemed compelling. But investors failed to appreciate the political risk. China is not a market economy. It is a state-controlled economy where the government can and does intervene dramatically in private businesses. We have seen this repeatedly over the past several years. The Chinese government destroyed the for-profit education industry overnight with new regulations. Billions of dollars of market value evaporated. The government forced Ant Financial to cancel its IPO at the last minute, wiping out investors who had been promised shares. The government imposed massive fines on Alibaba and Tencent and restricted their business activities. The government effectively banned ride-sharing company Didi from adding new users right after it went public in the United States. Investors who held China ETFs suffered devastating losses, and the risks have not diminished. The Chinese economy is struggling with a property crisis, weak consumer demand, and deflationary pressures. The geopolitical tensions between China and the United States are intensifying. The risk of conflict over Taiwan is real and growing. If China invades Taiwan, or if the United States imposes comprehensive sanctions on China, China ETFs could become essentially worthless overnight. Investors would be unable to sell. The underlying holdings would be frozen. The losses would be catastrophic. But the risks are not limited to China. Emerging market ETFs in general expose you to countries with weak institutions, unstable governments, unreliable legal systems, and currency risks. When crises hit these countries, and crises hit emerging markets regularly, the losses can be severe and sudden. In 2018, Turkey experienced a currency crisis. The Turkish lira lost 40% of its value in a matter of weeks. Turkey ETFs collapsed. Investors who had sought diversification found themselves concentrated in a disaster. Argentina has defaulted on its sovereign debt multiple times. Brazil has experienced hyperinflation and political chaos. Russia has invaded Ukraine and seen its markets essentially shut down to foreign investors. These are not theoretical risks. These are things that have happened and will happen again. I would get out of China ETFs immediately given the current geopolitical environment. I would be very cautious about any emerging market or single country ETF. These products expose you to risks that can materialize suddenly and catastrophically with no warning and no ability to exit. The fifth and final category of dangerous ETFs is complex or structured ETFs. These are products that use sophisticated strategies involving options, futures, swaps, and other derivatives. They have names that sound appealing, like buffer ETFs, defined outcome ETFs, covered call ETFs, and volatility-controlled ETFs. They promise to protect your downside or enhance your income or smooth your returns. The problem is that these products are incredibly complex. Most investors who own them have no idea how they actually work, and the complexity hides risks that only become apparent in extreme market conditions. Let me give you an example. Buffer ETFs promise to protect you from a certain percentage of downside loss in exchange for capping your upside. A typical buffer ETF might protect you from the first 15% of losses while capping your gains at 10% over a one-year outcome period. This sounds appealing. Who would not want downside protection? But the devil is in the details. These ETFs use options to create their defined outcomes. The options have specific expiration dates. If you buy or sell the ETF at any time other than the start of a new outcome period, your experience will be very different from what the marketing materials suggest. Additionally, these ETFs do not protect you from losses beyond the buffer. If the market falls 30%, you still lose 15%, and you have given up significant upside for that protection. In a strong bull market, your returns will be severely limited while you still bear substantial downside risk. Covered call ETFs are another example. These products own stocks and sell call options against them, generating income from the option premiums. They are marketed as income products for investors seeking yield. But they have significant drawbacks. When the market is rising, covered call ETFs dramatically underperform because the sold calls cap their upside. When the market is falling, they still lose money because they own the underlying stocks. The only scenario where they outperform is a flat or slightly down market, and they generate substantial taxable income that erodes returns for investors in taxable accounts. Volatility-controlled ETFs are perhaps the most dangerous of all. These products promise to manage your risk by reducing exposure when volatility rises and increasing exposure when volatility falls. This sounds like a sensible risk management strategy. But in practice, volatility-controlled ETFs often do exactly the wrong thing. They reduce exposure after a market decline when volatility has spiked, locking in losses. Then they increase exposure after volatility subsides, often right before the next decline. They buy high and sell low systematically. In the COVID crash of March 2020, volatility-controlled ETFs suffered devastating losses. They had reduced exposure too slowly on the way down and then missed the rapid recovery. Investors who owned them for protection found that the protection did not work. The fundamental problem with all these complex ETFs is that they are designed to appeal to your emotions, not to maximize your returns. They are marketed with phrases like downside protection and enhanced income and managed risk. These phrases trigger positive emotional responses, but the actual performance of these products rarely matches the marketing. I would get out of all complex and structured ETFs. These products are designed to generate fees for the providers, not returns for investors. Their complexity hides costs and risks that most investors do not understand. In a crisis, they will not perform the way you expect. Now, let me talk about what happens when these ETFs fail, because I believe many of them will fail, or at least fail to deliver what investors expect in the next market crisis. The ETF structure has never been tested in a true panic. The flash crash of 2010 gave us a small taste when some ETFs traded at absurd prices, some down 90% from their previous close for brief periods. The COVID crash of March 2020 gave us another taste when bond ETFs traded at massive discounts to their net asset values. But these were brief dislocations that were quickly corrected by Fed intervention or by arbitrage mechanisms kicking in. We have never seen what happens when there is a sustained crisis, when the Fed cannot or will not intervene, when the arbitrage mechanism breaks down completely. The arbitrage mechanism is what is supposed to keep ETF prices aligned with the value of their underlying holdings. When an ETF trades at a discount to its net asset value, authorized participants can buy the ETF shares, redeem them for the underlying securities, and sell those securities at a profit. This arbitrage brings the ETF price back in line with the net asset value. But this mechanism depends on the authorized participants being willing and able to conduct the arbitrage. In a crisis, they may not be. The underlying securities may be illiquid. The authorized participants may be facing their own problems and unable to deploy capital. The mechanism can break down precisely when it is needed most. I believe we will see significant ETF dislocations in the next major market crisis. ETF prices will diverge dramatically from net asset values. Investors who try to sell will receive prices far below what they thought their investments were worth. Leveraged ETFs will collapse. Thematic ETFs will be decimated. Bond ETFs will trade at massive discounts. The illusion of liquidity will be shattered. This is not a prediction about timing. I do not know when the next crisis will hit. It could be months away. It could be years away. But I know it will come eventually. Crises always come. And when this one arrives, the ETF industry will face its greatest test. Investors who own the 5 categories of dangerous ETFs I have described, long duration and high yield bond ETFs, leveraged and inverse ETFs, thematic ETFs, emerging market and China ETFs, and complex structured ETFs will suffer disproportionate losses. They will discover that the products they thought were safe, diversified, and liquid are actually risky, concentrated, and illiquid in a crisis. So what should you do instead? If you want to use ETFs, stick with simple, broad market index funds with high liquidity and low fees. A total stock market ETF, an S&P 500 ETF, a total international stock ETF. These products have trillions of dollars in assets. They are highly liquid. They own hundreds or thousands of underlying securities. They will hold up better in a crisis than the exotic products I have warned you about. Even better, consider owning individual securities. When you own an individual stock, you own a piece of a real company. There is no ETF structure between you and your investment. There is no arbitrage mechanism that can break down. There is no daily reset that creates decay. You own what you own. When you own an individual bond, you know exactly what you are getting. You know the interest rate. You know the maturity date. You can hold to maturity and get your principal back. There is certainty that bond ETFs cannot provide. I recognize that not everyone wants to pick individual stocks and bonds. It takes time and effort and expertise. For those investors, simple, broad market index ETFs are fine. But stay away from the exotic products. Stay away from the complexity. Stay away from the promises of enhanced returns or reduced risk. These promises are almost always empty. Let me also address something that the ETF industry does not want you to think about. The growth of passive investing in ETFs has changed market structure in ways that we do not fully understand. More than 50% of U.S. stock market assets are now in passive funds. These funds do not analyze companies. They do not make judgments about valuation. They simply buy and hold according to their indexes. This has several effects. It reduces price discovery, the process by which markets determine what companies are worth. When half the market is buying regardless of price, the other half has to do all the work of figuring out what things should cost. This can lead to mispricings that persist longer than they should. It also creates momentum effects. When money flows into passive funds, they buy all stocks in proportion to their index weights. This pushes up the prices of the largest stocks, which increases their index weights, which means even more money flows into them when new money comes into the funds. It is a self-reinforcing cycle that can push valuations to extreme levels. And most importantly, it creates the potential for violent reversals when the flows turn. If passive flows reverse, if money starts flowing out of index funds instead of into them, the same dynamics that pushed prices up will push them down. All stocks will be sold regardless of their individual merits. Prices will fall indiscriminately. The selling will beget more selling. We have not yet seen a major reversal of passive flows. Money has been flowing into ETFs and index funds consistently for decades, but flows can reverse. They have reversed in other markets and at other times. And when they reverse here, the effects could be dramatic. This is another reason to be cautious about ETFs, especially the exotic varieties. When the tide goes out, as it eventually will, you do not want to be exposed to products with structural flaws that will magnify the damage. Let me give you some historical perspective. In the 1980s, portfolio insurance was the hot product. Institutional investors used it to protect their portfolios from downside risk. It seemed sophisticated and safe. Then came Black Monday in October of 1987. Portfolio insurance turned out to have a fatal flaw. When everyone tried to use it at once, the selling overwhelmed the market. The Dow fell 22% in a single day, the largest percentage decline in history. In the 2000s, mortgage-backed securities were the hot product. They seemed sophisticated and safe, AAA rated, diversified across thousands of mortgages. Then came the housing crisis. Mortgage-backed securities turned out to have fatal flaws. When the defaults started, the securities collapsed. The entire financial system nearly failed. I believe ETFs, particularly the exotic varieties I have described, will have their own reckoning. The products seem sophisticated and safe. They have attracted trillions of dollars. But they have structural flaws that will be exposed in a crisis. The leverage, the illiquidity of underlying assets, the arbitrage mechanism that can break down, the complexity that hides risks. When the reckoning comes, investors who understood the risks and avoided the dangerous products will be protected. Investors who did not understand the risks will suffer. It is that simple. So let me summarize. The 5 categories of ETFs you should get out of before they collapse are as follows. 1. Long duration and high yield bond ETFs. These products have structural flaws that will be exposed when liquidity dries up. They have already suffered significant losses from rising rates and will suffer more if rates stay elevated. The liquidity they promise is an illusion. 2. Leveraged and inverse ETFs. These are not investments. They are trading tools designed for short-term speculation. The daily reset creates structural decay that destroys value over time. Holding them for more than a day is a mistake. 3. Thematic ETFs. These products buy high and sell low by design. They concentrate your portfolio in whatever is popular at the moment, exactly when valuations are most stretched. When themes fall out of favor, these ETFs collapse. 4. Emerging market and China ETFs. These products expose you to political, regulatory, currency, and geopolitical risks that can materialize suddenly and catastrophically. China in particular is facing severe economic and political challenges that make these ETFs extremely dangerous. 5. Complex and structured ETFs. These products use complexity to hide costs and risks. They are designed to appeal to your emotions with promises of protection and enhanced income. They rarely deliver what they promise and often do the opposite. If you own any of these products, I would strongly encourage you to sell them and move into simpler, safer investments. Individual stocks and bonds if you have the knowledge and time to manage them. Simple, broad market index ETFs if you want the convenience of passive investing without the structural risks of exotic products. The next market crisis will test the ETF industry like never before. Some products will fail their test spectacularly. Investors will lose enormous amounts of money because they did not understand what they owned. Do not be one of those investors. I have spent my career identifying risks that others ignore. I saw the housing crisis coming years before it happened. I positioned accordingly and made extraordinary returns. Now I see risks in certain corners of the ETF market that most investors are ignoring. The structural flaws are real. The potential for catastrophic losses is real. And the time to act is before the crisis, not during it. You have been warned. What you do with this information is up to you. But remember, when the crisis comes and you are watching your portfolio collapse, that someone told you this was coming. Someone explained the risks. Someone gave you the opportunity to protect yourself. The question is whether you will take that opportunity or whether you will learn this lesson the hard way. The choice is yours. Choose wisely. But before I close, let me go deeper into each of these categories because I want you to truly understand the mechanics of why these products are dangerous. Understanding the mechanics is the key to understanding the risk. Let us start again with bond ETFs because I think this is the category where investors are most complacent. People believe that bonds are safe. They have been told their entire lives that bonds are the conservative part of their portfolio. And for individual bonds, this can be true. But bond ETFs are fundamentally different animals. Think about what happens in a market panic. Everyone wants to sell at the same time. In the stock market, this creates dramatic price declines, but the market continues to function. Stocks are highly liquid. There are always buyers at some price. The price discovery mechanism, while painful, continues to work. The bond market is different. Bonds trade over the counter, not on exchanges. Each bond is unique, with its own coupon, maturity, and credit characteristics. Trading requires finding a specific counterparty willing to buy or sell that specific bond. In calm markets, this works fine. Dealers make markets. Buyers and sellers find each other. Transactions occur. But in a panic, the bond market can freeze completely. Dealers pull back. They do not want to take risk on their balance sheets. Buyers disappear. Sellers cannot find counterparties. Bonds that were supposedly liquid become completely illiquid. Now imagine you own a bond ETF in this environment. You want to sell. You enter a sell order and it executes immediately because the ETF trades on an exchange. But what price do you get? The ETF sponsor has to sell bonds to raise cash for redemptions. But the bond market is frozen. Nobody is buying. The sponsor has to either hold off on redemptions, breaking the implied promise of the ETF structure, or sell bonds at whatever price they can get, which might be far below fair value. This is exactly what happened in March of 2020. Bond ETFs traded at huge discounts to their net asset values. Investors who sold received far less than their bonds were actually worth. The only reason the dislocation did not become worse was that the Federal Reserve stepped in with unprecedented interventions, essentially promising to buy bonds directly to restore market functioning. But what happens in the next crisis if the Fed cannot or will not intervene? What happens if inflation is still elevated and the Fed does not want to risk reigniting it by flooding the market with liquidity? What happens if the crisis is so severe that even Fed intervention is not enough? These are not hypothetical questions. These are real scenarios that could unfold. And if they do, bond ETF investors will discover that the liquidity they thought they had was always an illusion. Let me talk specifically about the high-yield bond market because this is even more dangerous. High-yield bonds, also known as junk bonds, are issued by companies with weak credit profiles. These companies have high debt loads, weak cash flows, and elevated default risk. Investors buy their bonds because they offer higher yields than investment-grade bonds. In good times, high-yield bonds can provide attractive returns. Default rates are low. The extra yield compensates for the extra risk. Everyone is happy. But high-yield bonds are extremely sensitive to economic conditions. In a recession, default rates spike. Companies that were barely making their interest payments suddenly cannot make them. They default on their bonds. The bonds become worth pennies on the dollar. In the 2008 financial crisis, high-yield bond default rates spiked to over 14%. The average high-yield bond lost around 30% of its value. Many individual bonds lost much more. Investors who had sought extra yield found themselves with devastating losses. And the high-yield bond market is even less liquid than the investment-grade bond market. These bonds trade infrequently. The bid-ask spreads are wide even in good times. In a crisis, the market essentially shuts down. High-yield bond ETFs create the illusion of liquidity by trading on exchanges. You can buy and sell them anytime the market is open. But the underlying bonds do not have that liquidity. In a crisis, the ETF price will diverge dramatically from the value of the underlying bonds. Investors who try to sell will receive far less than they expect. I have seen estimates that in a severe crisis, high-yield bond ETFs could trade at discounts of 30, 40, even 50% to their net asset values. This is not protection. This is a trap. You think you own a liquid investment that you can sell at any time. In reality, you own an illiquid investment dressed up in liquid clothing. Now let me expand on the dangers of leveraged ETFs because I do not think most investors truly grasp how these products destroy wealth over time. The mathematics of leveraged ETFs is brutal. Because they reset daily, they are constantly buying high and selling low. Let me explain how this works. Imagine a 2 times leveraged ETF that starts the day with $100 million in assets, targeting $200 million in exposure. At the end of the day, the market is up 5%. The ETF has made 10%. Its assets have grown to $110 million. But now it needs to rebalance. To maintain 2 times leverage, it needs $220 million in exposure. It only had $200 million. So it has to buy $20 million more exposure. It is buying after the market has gone up. The next day, the market is down 5%. The ETF loses 10%. Its assets fall to $99 million. Now it needs to rebalance again. To maintain 2 times leverage, it only needs $198 million in exposure. It has more than that. So it has to sell exposure. It is selling after the market has gone down. Do you see the pattern? The daily rebalancing forces the ETF to buy high and sell low every single day. Over time, this creates a persistent drag on returns that compounds into devastating losses. In a volatile market that goes nowhere, a leveraged ETF will slowly bleed to zero. I have watched this happen. I have seen 3 times leveraged ETFs lose 90% of their value over periods when the underlying index was roughly flat. Investors did not understand the product. They thought they owned 3 times exposure to the market. They actually owned a product engineered to destroy their wealth. The mathematics is even worse for inverse ETFs. These products are supposed to go up when the market goes down. But because of the daily reset, they often lose money even when the market declines. Here's an example. The market starts at 100. It falls to 90 on day 1, a 10% decline. It rises back to 100 on day 2, an 11% increase. Over the 2 days, the market is flat. An inverse ETF that started at 100 would have gained 10% on day 1, rising to 110. Then it would have lost 11% on day 2, falling to 97.90. The market is flat, but the inverse ETF has lost money. This decay happens every single day. It is relentless. It is mathematical. And it is unavoidable given the structure of these products. Anyone holding leveraged or inverse ETFs for more than a few days is almost certain to experience returns that are far worse than they expect. I want to spend more time on thematic ETFs because these are the products that have attracted the most money from retail investors in recent years, and they are among the most dangerous. The fundamental problem with thematic ETFs is that they institutionalize the worst investor behavior. They make it easy to chase whatever is hot and to abandon whatever is cold. They are the financial equivalent of buying last year's fashion at this year's prices. Let me walk you through the life cycle of a typical thematic ETF. First, a trend emerges that captures investor imagination. Maybe it is clean energy. Maybe it is cannabis. Maybe it is artificial intelligence. Whatever it is, the stocks associated with the theme start to rise. As the stocks rise, investor interest grows. Financial media writes stories about the trend. Social media influencers promote the stocks. Momentum builds. At some point, an ETF sponsor notices the trend and decides to launch a thematic ETF to capitalize on it. This takes time. Regulatory filings must be completed. The ETF must be seeded. Marketing materials must be prepared. By the time the ETF launches, the trend is usually well established, and the associated stocks have already made significant gains. Now the ETF attracts capital. Investors see the strong returns and want to participate. Money flows in. The ETF has to buy the underlying stocks. This pushes prices even higher. More investors notice the strong returns. More money flows in. A feedback loop develops. At the peak, the thematic ETF has attracted billions of dollars. The underlying stocks are trading at extreme valuations. Everyone is talking about the theme. The narrative is universally bullish. Then something changes. Maybe earnings disappoint. Maybe interest rates rise. Maybe regulatory concerns emerge. Whatever the catalyst, sentiment shifts. Money starts flowing out of the ETF. The ETF has to sell stocks. Prices fall. More investors get nervous and sell. More stocks have to be sold. The feedback loop reverses. At the bottom, the thematic ETF has lost 60, 70, 80% of its value. Investors who bought near the peak have been devastated. The ETF may even close due to lack of assets. This pattern has repeated dozens of times across dozens of themes. Cannabis ETFs, clean energy ETFs, genomics ETFs, metaverse ETFs, SPAC ETFs. The specific theme changes, but the pattern is always the same. Money chases performance. Valuations become extreme. The theme disappoints. Prices collapse. And here's what makes it even worse. Thematic ETFs have high fees, typically 50 to 75 basis points annually compared to 3 to 10 basis points for broad market index funds. They have high turnover, which creates transaction costs and tax inefficiency. They are concentrated in specific sectors, eliminating the diversification benefits that are supposed to be the main advantage of ETFs. You are paying more for worse performance and more risk. This is not investing. This is wealth destruction, dressed up in fancy marketing. The current hot theme is artificial intelligence. AI-focused ETFs have attracted tens of billions of dollars over the past 2 years. The stocks in these ETFs have soared. The valuations are extreme by any historical measure. I believe AI is a real technology that will transform many industries. But that does not mean every company with AI in its name deserves its current valuation. Most AI companies are not profitable. Many never will be. The competitive dynamics are brutal. The technology is being commoditized. The returns will accrue to a small number of winners while the majority of companies fail. This is exactly what happened with the internet in the late 1990s. The internet was real. It did transform the economy, but most internet companies failed. Investors who bought internet-themed funds at the peak lost enormous amounts of money. The survivors, like Amazon and Google, generated huge returns, but they were the exception, not the rule. I expect the same pattern to unfold with AI. The technology is real. The transformation is real. But most of the current AI investments will fail. AI-themed ETFs will collapse just like internet-themed funds collapsed in 2000. Investors who are chasing the theme will be devastated. Now, let me discuss emerging market and China ETFs in more detail because the risks here are severe and immediate. For decades, the investment thesis for emerging markets was simple. These economies were growing faster than developed markets. Their populations were young and expanding. Their middle classes were growing. Invest in emerging markets and capture that growth. This thesis made sense in theory. In practice, the returns have been disappointing. Emerging market stocks have dramatically underperformed U.S. stocks over the past 15 years. Investors who tilted toward emerging markets missed the enormous gains in U.S. technology stocks while experiencing all the volatility and risk of emerging markets. Why did the thesis fail? Because returns are not just about growth. They are about the relationship between growth and the price you pay for that growth. Emerging market stocks were priced for growth that often did not materialize. And when growth did occur, it was often captured by insiders and connected parties rather than by minority shareholders. There are also fundamental governance issues in emerging markets. Accounting standards are weaker. Disclosure requirements are less stringent. Minority shareholder rights are less protected. When things go wrong, foreign investors have little recourse. But China deserves special attention because China ETFs have been enormously popular and enormously destructive of wealth. I want to tell you a story about what happened to investors in Chinese education companies. For years, these companies were darlings of the investment community. They were growing rapidly. The Chinese middle class was expanding and spending heavily on education for their children. The thesis seemed bulletproof. Then, in July of 2021, the Chinese government announced new regulations that essentially banned for-profit tutoring overnight. Without warning, companies that had been worth billions of dollars became nearly worthless. Stock prices collapsed by 80, 90, 95%. Investors had no recourse. There was no compensation. There was no gradual transition. The government simply decided that this industry should not exist, and it ceased to exist. This is what investing in China means. And this was not an isolated incident. The Chinese government has repeatedly demonstrated its willingness to intervene dramatically in private businesses. Alibaba was fined $18 billion for antitrust violations. Didi was essentially banned from adding new users right after going public in the United States. Tencent has faced repeated restrictions on its gaming business. The message is clear: no company in China is safe from government intervention. The property sector crisis adds another layer of risk. For decades, the Chinese economy was driven by property development. Developers built apartments. Consumers bought them, often with heavy leverage. Prices rose. Developers built more. A massive bubble developed. Now that bubble is bursting. Major developers like Evergrande and Country Garden have defaulted on their debts. Millions of apartments sit empty. Prices are falling. Consumer confidence has collapsed. The wealth effect from falling property prices is devastating to Chinese consumers. The Chinese government is trying to manage this crisis, but there are no easy solutions. Bailing out developers creates moral hazard. Letting them fail creates financial instability. Either way, the property sector is going to be a drag on the Chinese economy for years, perhaps decades. And then there is the geopolitical risk. Relations between China and the United States have deteriorated dramatically. There is real talk of conflict over Taiwan. If that conflict occurs, all bets are off. Chinese assets held by American investors could be frozen or confiscated. China ETFs could become worthless. I am not predicting that war will occur. I am saying that the risk is not zero, and when you own an investment where the downside scenario is complete loss, you need to be very careful about position sizing. Most investors have far more China exposure than is prudent given the risks. Finally, let me expand on complex and structured ETFs, because these products represent everything wrong with the financialization of our economy. These products are created not because they serve investor needs, but because they generate fees for Wall Street. They are marketed with sophisticated sounding language that makes investors feel like they are getting something special. They promise outcomes that sound too good to be true. And as the saying goes, when something sounds too good to be true, it usually is. Buffer ETFs are a perfect example. The marketing sounds great. Protect yourself from the first 15% of losses while participating in gains up to 10%. Who would not want that? But think about what you are actually getting. You are giving up unlimited upside for limited downside protection. In a strong bull market, you will dramatically underperform. In a bear market that falls more than your buffer, you still take significant losses. The only scenario where you outperform is a modest down market where the decline is less than your buffer. And there are complications that the marketing does not emphasize. The buffer is only valid if you hold for the entire outcome period. If you buy mid-period, your buffer and cap will be different. If you sell mid-period, you might not get the outcome you expected. The products are much more complex than the simple marketing suggests. Covered call ETFs are another example. These products sell call options against their stock holdings, generating income from the option premiums. They are marketed as income products for yield-hungry investors. But covered call strategies have a fundamental problem. They cap your upside while leaving your downside fully exposed. If the market rises sharply, you miss most of the gain because your stocks get called away. If the market falls sharply, you still lose money because the option premiums are not enough to offset the losses on the stocks. Covered call strategies can make sense in specific situations for sophisticated investors who understand exactly what they are doing. But packaging them in an ETF and marketing them to retail investors seeking income is problematic. Most of these investors do not understand that they are trading upside for income in a way that is likely to leave them worse off over time. And then there are the truly exotic products, ETFs that use complex volatility strategies, ETFs that combine multiple layers of derivatives, ETFs that make bets on the shape of the yield curve or the correlation between asset classes. These products are so complex that even sophisticated investors struggle to understand them. I have a simple rule. If I cannot explain how an investment works in plain language to a reasonably intelligent person, I do not own it. Most complex ETFs fail this test. Their mechanics are opaque. Their risks are hidden. Their performance in extreme scenarios is unpredictable. And that unpredictability is the real danger. In normal markets, these products seem to work as advertised. But we do not buy insurance for normal times. We buy insurance for disasters. And in a disaster, these complex products can behave in ways that no one predicted. The lesson from every financial crisis is that complexity hides risk. The mortgage-backed securities of 2008 seemed sophisticated and safe until they collapsed. The structured investment vehicles seemed like clever ways to generate yield until they imploded. The portfolio insurance of 1987 seemed like prudent risk management until it caused the crash. Complex ETFs will add another chapter to this history. When the next crisis comes, some of these products will fail in ways that their creators did not anticipate and their owners do not understand. Investors will suffer losses that they never knew they were exposed to. Do not be one of those investors. Stick with simple products that you understand. Avoid the complexity. Avoid the marketing promises. Avoid the too good to be true outcomes. That is my message. 5 categories of ETFs to avoid. Long duration and high yield bond ETFs. Leveraged and inverse ETFs, thematic ETFs, emerging market and China ETFs, complex and structured ETFs. If you own these products, sell them before the next crisis exposes their flaws. Move your money into simple, broad market index funds or individual securities that you understand. The financial industry does not want you to hear this message. They make billions of dollars in fees from these products. They have armies of marketers promoting them. They have financial advisors incentivized to sell them. But I have no such conflicts. I make money by identifying mispricings in markets and positioning accordingly. I have no ETFs to sell you. I have no fees to collect. I am simply telling you what I see. And what I see is an industry that has grown too complex, too profitable for Wall Street, and too dangerous for Main Street. An industry that has created products designed to generate fees rather than returns. An industry that has sold investors sophisticated-sounding products that will fail when they are needed most. The reckoning is coming. When it arrives, investors in these dangerous products will suffer. Investors who heeded this warning will be protected. Let me leave you with one final thought. Throughout my career, I have made money by being early. I was early on the housing crisis. I was early on several other trades. Being early is uncomfortable. It means watching others make money while you wait. It means being told you are wrong. It means enduring doubt and criticism. But being early is better than being late. If you wait until everyone agrees with you, you have already missed the opportunity. If you wait until the crisis is obvious, you cannot protect yourself because everyone is trying to sell at the same time. The warnings I have given you today about these 5 categories of ETFs may seem premature. The crisis has not happened yet. These products are still popular. Money is still flowing in. You might think you can wait, that you can sell when the crisis begins. You cannot. By the time the crisis is obvious, it will be too late. The products I have described will already be collapsing. Liquidity will have evaporated. You will be selling at the worst possible prices. The time to act is now. Not when the crisis begins. Not when prices start falling. Now. Before the crowd realizes what is happening. Before the stampede for the exits begins. I have been right about these things before. I may be wrong this time. But the risks are real. The structural flaws are genuine. And the potential for catastrophic losses is significant. Given those facts, the prudent course of action is to reduce your exposure to these dangerous products while you still can. 10 years from now, you will look back on this moment. Either you will be glad you heeded the warning and protected your wealth, or you will wish you had. The path you take from here determines which of those outcomes you experience. I have done my part. I have explained the risks. I have identified the dangerous products. I have given you the information you need to make an informed decision. Now it is up to you. The choice is yours. Choose wisely.